Hi, I hope everyone is doing well. So we will continue this series of videos where we are covering some of the metrics that are helping us measure or evaluate the performance of or the execution of our trades. And of course, we want the best execution possible. We want to reduce the transaction cost as much as possible. And this type of analysis helps us improve performance overall. Okay. Now, usually in when we are talking about performance, we refer to beginning value and the ending value of a single position, and it becomes quite apparent and simple that, well, we just calculate the return. Now, if we look at a transaction ledger, if we are trading and we are trading constantly, then we're going to see that things become convoluted in the sense that, well, we're buying and then we are selling part of those shares in ABC stock, but we're not selling all of them. So we will still keep some of the shares. And then we're adding another position in another share in another stock. And then we're selling, but we are partially selling again. So things become complicated because our transaction ledger involves more than one stock, involves different quantities every time, involves purchase volume that we're purchasing in repeated opportunities, and it also involves partial sales and in repeated opportunities too. So a very helpful approach is the money weighted rate of return. This is something you may find in the material if you're moving in the direction of CFA or many other certifications. Money weighted rate of return is quite important. Let's not forget that money weighted rate of return is what we have mathematically is essentially what we have already learned in capital budgeting in the first core finance courses as internal rate of return. So that's essentially now money weighted rate of return. Instead of weighting by the volume, instead of weighting by time, like the time weighted rate of return we're going to see very soon, we are weighting by the amount of money. And that is quite intuitive. That is quite important because those transactions on which we put more of our capital, those are the ones who are likely going to determine the performance of our portfolio overall. So now the money weighted rate of return is very good in giving us a good performance rate of return that captures this dimension. Okay. So how do we calculate it? There's a lot we can talk and say about the money weighted rate of return, but as usual, I'm going to focus on the calculations that are needed to get this metric. And maybe in other videos, we can sort of go over this metric more from the theoretical perspective. So if we're getting the money weighted rate of return, the first thing is to determine which are the direction of the trades, which are the buy orders and which are the sell orders, partial or complete. We list them all over a window of time. In this case, this corresponds to the month of May, and then we will have the volume of shares and we have the price of each one of the orders. Okay, now I am adding this sign here, which is going to convert buy into a negative cash flow and sell into a positive cash flow. If we are buying, it's an outflow, we have to pay. Okay, we have to invest in order to buy, to take a long position in a stock. And when we sell, it's a positive cash flow, it's an inflow. So the sign, we will do it since we all have already defined here if it's a buy or sell, the direction of trade. We will use a simple if command. If this is equal to buy, then this is going to be -1. Else, this is going to be 1. Done. because I am only listing buy, sell, buy, sell, buy, sell, I did not make this more specific. If it's not a buy, therefore it has to be a sell. But if you have a list, a transaction ledger with other potential types of activities listed here, then you may want to make this more specific. Something maybe like if L is a buy, then -1. If not, then you can add another command, which is if L9 is equal to sell, right? Then it's going to be +1, and then you have bought. If none of this is holding, then you will have maybe something like error, right? Okay, but in here, since we just have buy and sell, I can keep it very simple like this, and I can scroll this down all the way to the bottom. By the way, if you place the cursor here, it turns into a smaller cross. When you see that cross, you don't need to click and drag down. You just need to double click, and it will drag the formula down all the way to the bottom. Okay. An important thing is this will only work if these two columns are adjacent. But if you have an empty column in between, that little trick would not work. Okay, so let's always keep that in mind, but that is very helpful. So now the cash flow is simply the number of shares times the price of the shares times the sign. And once again, because there is no empty column between these two, I can just place the cursor here, double click, and it will drag it down. Once I have all the cash flows, essentially I have a list of negative cash flows, which are considered by Excel or the internal rate of return formula, the money weighted rate of return as investments, cash outflows, and then you have cash inflows. And therefore we just do equal IRR, and then we just select, and there we go. We have that 19%. Let's see if there are any decimals here. Okay, 19.02. Okay, so there we go. That's the calculation of the money weighted rate of return. This type of cash flow has sign switches. So in that case, you have positive cash flows, negative cash flows, positive cash flows, negative. The money weighted rate of return, this is the way it sort of gives us this metric, which is using the internal rate of return. The command is IRR in Excel. Now there could be a potential critique, which is that when cash flows behave like this, there are switches. There could be more than one solution. The internal rate of return in essence, it's that rate that leads to a zero net present value, and some issues could arise. But so far, as of now, money weighted rate of return, we just get it using the internal rate of return. If somebody would like to look at any potential flaws of this measure, and you would like to calculate this in a more precise way, then you may look at the modified internal rate of return, although that is not, quite frankly, common. But that's something that you could explore and see whether and how it would make sense. But for this video, this class section, this money weighted rate of return, this is the way to calculate it. And then the other possibilities would be a different, essentially correspond to a different topic, and we could talk about that later. Now, time weighted rate of return, okay, which is simply the geometric mean in finance if we take the average of the time-weighted rate of return, right? But arithmetic mean has a couple of flaws, and I will just quickly illustrate because it's always a good idea if you have the following, for example, returns. You have minus, and I will exaggerate a little, minus 80%. And then you have minus 5%. And then you have plus 5%, and then plus 82%. Okay, arithmetic mean would tell you that this rate is positive, 0.5. I mean, we could even do it, we could even say 90, okay, 2.5, just to make it. So this is the arithmetic mean. There is a very well-known flaw, which is that arithmetic mean does not account for, or is not considering compounding, or in other words, the effect of time. This 80% occurs in the beginning of the investment horizon. It means that if you invested $1 million, that means you're losing 800,000. Now, by the time you get to this 90% here, you already have a very small amount. So this is a 90%, but it is a 90% of a very small amount of money. So for that reason, the time-weighted rate of return, the way it works is, okay, let's add 1 plus each one of these returns. So we can call this price relatives. What is that 20% if we try to understand it? Well, after this return, this is what is left of your portfolio. And then we add 1 at each one of the returns. And then we can get the product of 1 plus the return. So keep in mind, this is just 1 plus the return, price relative. Then we take the product of these different price relatives, right? There we go. And once we have done that, then we subtract 1, the last step. So we added 1, now we're subtracting 1 to bring it back to where it was. And look at this, now this is telling you, hey, if you're having this return distribution, you are not expecting, if you're investing in a product like this, you're not expecting a positive performance. You are expecting a really negative performance. Actually, you're going to lose about more than 62% of what you invested. Okay, and we can easily see that, and you're going to sort of connect where the price relatives are become relevant, because if you have 1 million, that's the initial value, right? And then you lose 80%, right? So then you will have, how much money do you have as the ending value? Let's better do it like this, ending value. So it's simply 1 million times the price relative. You have 200,000 after you lose 80%. What is the initial value of the next period? Well, the ending value. Now, what about now? You multiply this by that 90%, you lost 5% of the 200,000. So now your portfolio drops to 190. Okay, so the next period you started with the 190,000, and by the end of that period, now you finally start getting this 5%, which means that 190,000 will grow by a factor of 1.05 or 105%. Means it's going to move from 190 to 199,500. You got 5%, but that 5% is not on the 1 million anymore. Now that 5% is only on 190,000. So it only represented 9,500, a much smaller amount. Then your next period, you started off with almost 200,000, not even 200,000. And then finally you hit this mark, the 90% large return you have at the end. But now that 90% is based on the 199,500. So if you multiply that by the price relative, that yes, is a very good return, but it's only going to take you up to $379,050. Okay, so from 1,000 to 1 million, if you have invested in this product, your ending value is 379,000. You have lost 62.09%, which is what the geo mean is giving you. and then in this case, the arithmetic mean is quite misleading. Okay, now this type of effects is less and less relevant the longer the data that you have or that you are using to evaluate your a given portfolio, the historical values. Um, Given that, then these potential distortions, like you have most of the negative returns first and then most of the positive in the end, these type of distortions are less likely to happen if you have a long time series. Okay, and actually, the longer the time series, at some point it will become normal, and then the difference is less. It's not this. It's not that sharp, but this is just an like I'm exaggerating these values to make it very clear what the problem of the arithmetic mean is. It just ignores the timing of the returns. It ignores that this is happening first. So it has a bigger detrimental effect compared to this one. Geometric mean does account for that, and therefore it's most of the times a better measure. Okay, so going back to this problem, in once again we have a ledger, we have values, beginning values, ending values. So we have to calculate returns ourselves. We can do this ending value divided by beginning value minus 1. That gives you a percent. I'm not doing anything sophisticated in dividing those and subtracting 1. I am simply doing ending value minus beginning value, and that is profits, right? 210,000. And the profits divided by your initial investment, that is percentage return, holding period return. We have to add all of we have to add the different cash flows also that we expect in between. So now I just keep that formula and I scroll it down. There we go. Now we have all of these returns. And now we get time-weighted rate of return, geometric. So we will do 1 plus these returns. And there we go. And now let's calculate the total. If we have those values reported some sort of on a weekly basis based on what I'm seeing here, okay, then what we can get the overall return, geometric return for the month of May simply by doing product of all this and then minus 1. Okay, and that's it. Okay, however, if we want to get the average weekly rate of return, time-weighted rate of return, average per week, let's say average per week, then the way to get that would be this value. Well, let's do it again. Product of all of these price relatives, and then to the power of, we're going to take the nth root, in this case, the fifth root, or 1/5, or 1 over count of these values. Okay, and then minus 1. And then that would be the time-weighted rate, the average time-weighted rate of return per week. But if you're getting the overall time-weighted rate of return for the whole month, we just need to get the product and subtract 1. Now, another way of getting the average per week or the May total return would be what usually we are familiar with the concept of compounded annual growth rate, and the formula is, well, you take the value at the very end, right? And then you divide it by the value in the very beginning when everything started. Okay, and then that division, right, we raise it to the power of 1 over the we are looking at the return on the month of May, so that minus 1, and there we go. If we want the compounded, an equivalent of the compounded annual growth rate but weekly, an average rate, then we would do the value at the very end, not here, not there, but here, divided by the value in the very beginning. At this point, if I simply subtract 1, that is giving me the overall return for my portfolio from the first observation I have in May until the last observation I have in May. But I'm interested in the average per week in this case. And then I would do the same we did in the row above. So we would raise this to the power of 1/5 and then -1. And it's just giving us. So you have two different ways. You can get all of these price relatives, multiply them, then raise them, multiply them and subtract 1, and you would get the overall return for May. Or you can take the ending value of May divided by the beginning value in May, subtract 1, you get to the same number. And the average, you could do it as, if we're looking at the time-weighted rate of return, product of all the price relatives to the power of 1/5, the fifth root, -1. And that gives us the average, or in compounded weekly growth rate, if we think about weeks instead of years, then ending value divided by beginning value to the power of 1/5 -1. Okay. And now we can, of course, annualize these values once we have gotten to this point. This is a monthly return. One important thing is whenever we report performance, we should always report performance on an annualized basis. It simplifies things. If not, you would have a report, you're saying that you're getting 8.8%, and it would be hard to know if that is a good return or not. Because you would need to then specify, oh, this is for a single month. And then maybe your another report from another market participant would be reporting a performance of 8.8, but now this is over a 10-day period. So we don't want those periods when we are reporting performance. If everyone is reporting on a different horizon basis, it would be really difficult to compare apples to apples, or we would get confused. So we usually analyze performance once we have a monthly return like this. This is the overall return for May. This is the overall return for each of these weeks. If we go over May, then we would take 1 plus the return in May. Any of these two is the same. And then we raise it to the power of 12 -1. So that would be the effective annual rate. 1 plus the periodic rate raised to the power of the number of periods in a year -1. That we have seen it before. Okay, and of course, these numbers are hypothetical. That would lead to a very high return on an annual basis. And if we look at the weeks, it would be similar. 1 plus the periodic return raised to the number of periods in a year -1.